All right. Trey Griggs, founder of Obsidian Wisdom. Welcome to another Retirement Readiness Thursday. Today we focus on safer investments, the kind that helps you sleep comfortably at night. It's worth noting that when it comes to our investments, all of them don't have to be home runs, that you can win baseball games with singles, bunts, doubles, triples, that everything doesn't have to be a home run. A lot of time when we look at investments, most people are like, I want to make sure I have the highest return possible. And the reality is there is a trade-off. That's what economics at the end of the day is. There's always a trade-off. And so you have to decide where's the balance. You actually just saw the Fed had lowered their Fed fund rate another 25 basis points. And so now it's somewhere, I think it's about 3.75 to 4% is where the Fed fund rate is. And that rate directly impacts what the interest rates you and I will receive are. And our loans that we get, we recognize that the interest rate is going to be lower as the Fed fund rate, the rate that they give money out. But with that said, the president is like, hey, you should just lower it. Just lower it to like 2% and just leave it there. It'll be easier for businesses. It'll be easier for consumers. It'll boost the economy. So the question is, and I ask you just to open it up, why don't we just leave the interest rates at 2%? Why don't we just leave them at 0%? They were at 0% right after the Great Recession for a while. Why don't we just leave them at 0% forever? And I think you recognize that the trade-off, the reason that we don't have lower interest rates is you can historically, and you can look at the chart, and I'll probably pull it up for you. The interest rates are low when we're in a recessionary climate because we don't want to go into a depression. Interest rates can't stay low forever because it causes too much growth. So if you're in a depression recession environment, sure, no problem. We're literally not growing. We're contracting, right? That's the definition of a recession. So I have to lower the interest rates. Otherwise, we're going to keep contracting, which is your shrinking economy until the point that like it's kaput, right? We're in a depression. So we want to climb out of a recession, but then why not just continue growing forever? Right? Like what's wrong with that? GDP, we generally have a 3%. Generally speaking, we consider full employment around 4%. Why not just give literally everyone who wants a job a job? Why not have your GDP grow by 10% every year? Because if you kept the interest rates at like 2%, that's what would happen. And I think we remember, well, what happened to make the interest rates go up? All right, what happened to make them go up? You're like, oh, yeah, that's right. We just came out of COVID and we have 40-year high inflation. And you are correct that the interest rates are low and your economy is red hot. That creates hyperinflation, like just the awful kind of inflation where you literally would get your paycheck today and you would go buy something today because you're like, this money is going to be worth so much less tomorrow. So even the Fed has to balance in the trade-off between people having jobs versus people having growth versus inflation. And so we recognize that when you're choosing between hyperinflation and full employment, or hey, have some people unemployed, so that way people will start getting lower wages, because you and I both know there's an amount that we will accept, there's an amount that we won't accept, and that amount is different if we have a job already. And so when you're looking at interest rates, and it's so important to recognize these cycles because this will impact the interest rates that you're offered. And we're going to go through a handful of these so you can recognize the climate. But I know it becomes political. Everything's political. You guys know me. I'm not big on like culture wars. I feel like, I know it's going to sound like all, pinky up on me, but I feel like that's beneath me. I like to have economic wars. I think that gives a tangible material benefit to everyone's life, that you can win the culture war and your life can literally be unchanged and actually be worse off. But you won the culture war, right? What did you win? And so for me, I focus on the economic wars. The culture is in my own household, the culture I have for my family and the way I raise them. I'm less concerned about how everyone does their own house. Like, that's just me personally. Everybody's different. That's me personally. So when you're talking about the idea of interest rates, and we recognize that interest rates are starting to go down, that is a sign that we are in a recessionary climate. There is concerns. But at the same time, the Fed only lowered it 1/4 of a point. Well, why is that? Because remember, the dance is, I don't want to be in a recession, but I don't want to be hyperinflation, right? So we're trying to be in the middle of the trade-off. And there are still inflationary pressures from the tariffs. So the numbers are showing that the cost of things are going up. I've seen some where some of the things that people are buying more of, that a lot of the metrics from people not paying on their car loans, that number is going up. The number of businesses that have filed for bankruptcy, I think it hit 10% in like June or July. So that number was going up. And then I actually just saw one. It was like a viral video because the host was talking about that the purchasing of Hamburger Helper is up 15%. And they were like, I remember when I was a kid eating Hamburger Helper, and you and I recognize, yeah, in economics, there's these things called like normal goods and inferior goods. And the idea is if you buy normal goods and you get more money, you'll buy more normal goods. If you get more money, then you won't buy the inferior goods. You'll only buy more normal goods. And so an example of that would be like me in college, I ate ramen noodles all the time. When I made more money, I did not buy more ramen noodles. The ramen noodles was an inferior good. That's why I bought them. No offense to Hamburger Helper, but it would be on the list of inferior goods. People buy them when they have less money, not when they have more money. That when you have more money, you wouldn't buy Hamburger Helper. And so we look at all these signs and we know that interest rates are probably going to go down, but it doesn't mean that they're still not valuable. And as far as our long-term plan, the idea of having this safety net, having money that still will make money in a variety of economic climates, but we recognize that there is a trade-off, that as interest rates go down, then the money that you loan and borrow, those rates go down too. So it's not just when I buy a house, that interest rate is down from the bank. It's when the bank borrows my money, they also lower the interest rate that they give me. And so I say all that to really talk about, like, it's still a place in your plan, but we do need to recognize moving around that they're going to change. And so currently what we'll do is I will pull up where some of the numbers are right now. Then I will pull that up on my screen. So I'm gonna add it to the stage. All right, so it should be currently you could get a 10-year treasury at 4%, which is pretty good because the goal of our safe money in a ideal situation is going to be about the idea of I would love to keep up with inflation. So when we're looking at our safe bucket, ideally I want to have something that's pretty liquid. Like that's generally speaking goal number one. This is the money that I'm able to access, and it's not going to be a big pay cut when I take the money out. And so when you're looking at things like that, like if you had real estate, there's a time when you won't be able to sell your real estate without it having a significant loss. But when you have your safe investments, it doesn't really matter. And so, right, there's some of them that we set up where we give out these loans and we set them up. And then on the other end of it, we recognize that the trade-off, of course, always exists. I think we have a question. Let me see here. Ronald, how are you, my friend? He said, well, what about growth to compensate hyperinflation? All right, so excellent question, because it is true that you do grow. And the way that we normally think about inflation, and what I will shift to my whiteboard real quick. So normally when we're thinking about inflation, there's really a couple ways to think about it, right? So normally we'll say like me, and that's like my wages, right? So that's like me. And then we'll have the cost of things. And so if my wages, so let's say we were in that 40-year inflationary environment, right? The one that we were just at right after COVID. If the cost of things goes up by 10%, as long as my wages also go up by 10%, we're fine. No harm, no foul. Sure, my salary went up, but my costs went up. I'm living my same lifestyle. Everything's the same. If it goes up, but your salary went up by 15%, let's just say you're a rock star, then you're actually happy. You're like, dude, I'm able to buy more stuff. I'm going to the caviar restaurants. I'm doing pretty good, right? So we're happy here, and we'll just say we're normal here. That's my normal face. I know he doesn't look happy, but that's my normal face. The issue becomes if my wages goes up by like 5%, but inflation and my cost is by 10%, right? No bueno, right? That's no good. And what ultimately ends up happening is you and I recognize that most businesses, there's like two things. One is, let's say that they're doing everything on the up and up, and it's just simply a contract thing, where the contract that we signed, we assumed inflation was going to be 3%. I agreed to get a 5% raise for the next 5 years, and then inflation is 10, 15, 20% as it keeps going up, I'm dependent on that business being nice enough to just go in and change my wages. And I like to use the NFL for my examples, right? Like Brock Purdy, I don't know if you watch football, but he is the quarterback for the San Francisco 49ers, but he was the literal last pick of the draft. So he was on what's considered a league minimum salary, which is like 900,000 a year. But the average NFL starting quarterback makes $55 million a year. And they didn't care. They're like, dude, you're under contract. Yes, you're underpaid. It's okay. You'll get your new contract later. Now, fast forward, he just got a new contract. I think he gets like 53 million a year. So he's like right around that average. But he was making 900,000 for several years being underpaid. And so a lot of the times what ends up happening is our wages don't match inflation. So at best, they'll raise them next year off of last year's inflation. So I have to live through that. And then at worst, they don't actually match it, where they raise my wages some, but it doesn't match the cost of things. Because if you really think about it, one of your number one costs as a business owner is going to be your employees. So it's almost like you can't catch them. That is like, all right, I gave you a 10% raise, but then my costs are 10% higher, but now you and your 10% of your salary. So now I need to raise my cost again. And it's almost like you can't catch it. And I think it's called the price wage spiral. Actually, I think that's what it's called. And so we deal with some of those pressures. Excellent question. Excellent question. All right. Okay. So the idea of our safe investments, our sleep well at night, the way that we would normally think about it. Let me remove this. The way that we normally think about it is we have our 3 buckets. Right, so we have our 3-bucket strategy. You have your safe bucket, you have your moderate bucket, and then you have your growth bucket. When we're talking about our safe bucket and some of the things that we're looking for in our safe bucket, we're normally thinking, right, one, peace of mind, that generally speaking, if you have your money that's set in like a bond or a CD or a money market account or something like that, if I put in $1,000, I expect there to be really close to $1,000 tomorrow. If you invested $1,000 in something super aggressive like a cryptocurrency, a Bitcoin, something like that, if you put $1,000 in today, there is no guarantee that that's worth $1,000 tomorrow. It could be worth $100 tomorrow. It could be worth $10,000 tomorrow. But there's a lot of risk in that. We don't really know what it's going to be tomorrow. And so when you're looking at the safe bucket, it does have a purpose. And I do think that that's often underlooked sometimes. And that the goal, of course, we're not going to get rich from it, but its purpose of the safe bucket is to make sure that you don't go broke, right? Like that's the purpose of the safe bucket. So when you're talking about Bitcoin, sure, you can hypothetically get rich off of Bitcoin, but you could hypothetically go broke off of Bitcoin too. And so this particular bucket, our main focus is making sure we don't go broke, right? That's the idea of this bucket. And so we want to have streams that are predictable and that they're able to maintain our lifestyle. And it is the foundation, is the absolute floor where you're almost like, these are my needs. So you have your needs kind of covered with these streams, and then we'll go through that. And so when you're looking at these, there's a handful of things that will range from safe to light safe on the moderate side. And then, of course, we mentioned one of them, right? So one of them is your bonds. And so all a bond is debt. And when you're talking about debt, you normally get them from 2 places. And so you'll normally get your debt from, number 1 is going to be the government. And then number 2 is going to be a corporation, a business. And just like any other loan, any other debt, like on the consumer side, you and I recognize that the interest rate is tied to how good someone's credit is. That if someone has an 800 credit score, they're going to get the lowest interest rate possible if they wanted to buy a new house or a car or something like that. We recognize that if someone has a 500 credit score, that if they get approved, they're going to be charged a much higher interest rate. And so when you're talking about debt and buying these bonds, there are what we call junk bonds out there where they're offering you 10, 20% because they have a bad credit score from a company perspective or from a country perspective. And you're probably like, well, Dre, what would cause a country to have a bad credit score? And I'm glad that you asked. In some ways, it's the exact same. They just don't pay their bills. So the United States, we have received downgrades during different shutdowns where we weren't paying different bills and different things like that over the past maybe 15 years, where we had our credit rating lowered because it was like, well, the United States may not pay their bills. Now, a lot of people they still don't change their investment habits because it's the United States, but it is worth knowing that that's a thing, that if you're not paying your bills, you can get lowered for that. We also normally look at things like your courts. So if your courts are really corrupt, where where the country is lying on their numbers and they're pretending like everything's okay, or like there's a variety of things that increase the risk of investing in something. And so that would be kind of the same idea, that if you have corruption, if you don't pay your bills, if you have a ton of debt, if you just have like all these different issues as a country, then we would say, yeah, you're not really the safest investment. From a corporation, it's sort of the same idea. We look at their debt, we look at their leadership team, seeing how competent they are. We look at the vision, maybe even what industry that they're in. We're like, yeah, I like your leadership team, but you're in the newspaper industry. I'm sorry, it's not looking good for you. And so there are a handful of things that we also look at from the debt of a corporation. And so we have investment grade bonds, we have junk bonds, and then they have ratings. So you have everything from A's and then the B's, and then they go down to C and maybe even a couple D's. But for the most part, the grading scale is actually very confusing for the average person because it's like AAA and that's like AA. And you will see that a AA is actually considered below investment grade. And you're like, well, why wouldn't you just give that person a C, just a regular A, B, C, D that we're all used to? But they don't have F. F doesn't exist. That would offend the businesses, even though it would give us a very clear signal. So instead, it's like AAA, AAA and a B, and then it's like a AAA and two Bs, or you're just like, what does that mean? And then it's like, and then there's like AA, and it's very, like I said, it's very confusing. I would definitely encourage you to look up to see what their ratings are, and so that way it will give you a little bit of an idea. Because I'm just telling you right now, if I wasn't reading this stuff every day, I would look and think someone with a AA rating would be an investment grade. And I'm telling you that that's just not that, right? That's just not the case. And so you already saw, I showed it to you, that the bonds currently are set around like 4% for the 10-year. And that's that's pretty good as long as you're choosing a stable, reputable company and you can. And so we're saying that I will let you borrow my money, right? So it's your debt. You're saying, hey, I don't have the money to do whatever I'm going to do as a country, do whatever I'm going to do as a business. So can I borrow your money and do the project and then pay you back with interest? And so from a risk perspective, because you're in bonds, if they were to go bankrupt, you would get paid back in the bankruptcy proceedings. Just like if you and I filed bankruptcy, everyone that we owed credit to, debt to, they would be able to get some sort of a payment back. And that's the difference between bonds and equity. See, equity, you're a business owner, right? Like you own equity in the company. So the stock market, you buy equities, which means that if that business goes bankrupt, because you are a business owner, you're not guaranteed to get any of your money back because you're a business owner. So you're taking on that risk. We recognize from a bond perspective, I'm not supposed to be taking on significant risk. I am letting you borrow my money and you should pay me back. And so we're going to do it just like a car payment where we repo the car if you don't pay us back. It's the same thing when it comes to you giving out money to countries and when you give out money to businesses. On the flip side, the reason it's set at 4% is just like your car payment, just like your mortgage payment. You have it set $100,000, $1,000 a month, and then you pay back over a set number of years, and the interest is calculated in that payment. So it means that if you give the money to a business, if that business comes up with a phenomenal idea that literally generates $1 trillion, you still just get your $1,000 a month. You don't get the upside, but you also have the downside protection. So that's the trade-off in the bonds, but it is your safety blanket. And you're able to ideally keep up with inflation. We do recognize that that's probably going to be a little bit more difficult as the interest rates keep going down, if they keep going down. But if you made me guess, I would say that I would assume that they're probably going to hold at their next meeting because there's still so much inflationary pressures that it's very hard to continue lowering it because it will lead to hyperinflation. And so they don't want, the goal of lowering interest rates, like I said, is you're literally in a recession and they don't want you to go into a depression. Generally speaking, you can't be high, you can't have a teetering economy where you're kind of in the middle, We haven't stopped into a recession, but we're not super economically growing either. That you normally, if you're in the middle of the cycle, you just normally let it ride out. That's generally speaking what the Fed is going to do. Because if you lower the rates too quickly, it's going to boost you back into that economic expansion, and you never really went deep into a recession, and it ends up causing hyperinflation and things like that, right? Like, so it starts having those things happen. But as far as our investments, we recognize that there might be a time just like 10 years ago when interest rates were literally at 0% and they were giving you 1% on your money. But we're going to stack this with some other options, and they're still all going to be relatively safe. But I do want to make you aware of that. Sometimes that's why we'll do things that we'll call like a bond ladder. And I won't go into like all the details, but the idea is if I just every single year, so like 2025, 2026, and 2027, and so on, if I just bought, I don't know, let's just say I bought 10K each year, and whatever the interest rates were that year, I would have this bond ladder. And then at some point in time, as we go through our economic cycles, right? So we have economic growth, then we have the peak, and then we have the contraction, which is a recession. And at some point we hit the trough, and then we have economic growth again, right? So economic growth is going to be the start of the new cycle. The idea is if I bought 10K here, the interest rates are probably still low and just starting to increase when you start getting to the top. So you might have, and if you were someone who had bought some bonds right around that time when we were at the 40-year high inflation, you probably were able to get like a 7%, which is kind of nice. Right? If you really just take a step back and think of it, you're like, man, that's pretty nice. I'm just giving out debt and you're going to pay me back at 7%. Like, I'm out here winning because the interest rates were higher. At the same time, people stopped buying houses, people stopped investing in businesses because the money was more difficult to be able to pay it back. But it's possible that you were able to lock in a 7% here. And then we're somewhere around here right now, which would have you around that like 5%. And then you've seen that we're kind of at that 4%. And then at some point you hit the floor. The floor is probably going to be 2% or 1%, depending on how low the floor is. And so you will have a blended portfolio. So you'll have $10,000 that's getting you a 7% return. Then you have your $10,000 that's getting you like a 5% return. And then you're going to get your 4% return. And then you'll probably have a 1% return in there as well. And then at some point you'll start getting back to economic growth, and then we'll come back to hyperinflation fears. And at some point you'll have the high interest rates again. And so you recognize that you will have this, but as long as you're steadily building your ladder out, you should be able to maintain a relatively decent rate. Because a couple things happen is, one is when you are in a market when it's 5%, that means that people are willing to pay a premium for your 7%. Because they're like, dude, I've looked everywhere and no one is offering a 7%. And you're like, I know, I got it, last year or 2 years ago. And they're like, how about I pay you the equivalent of like 9% because I really want to have that 10 years, that 7%. That would make my day. And you get to decide whether you want to sell it. And so you'll recognize in each of these climates that when we drop to the 4%, that if you had a 5%, people are like, man, how do you have a 5%? You're like, yeah, I know, I got it last year. And we're sort of doing that even right now where they just lowered it again. Well, if you last year it was probably like 4.5%, I think last year was around 4.5, 5. So you got a 4.5, 5 last year, and you're looking at the numbers this year. The numbers this year are going to be like 3 now. They're going to be like 3.5%, 4 at the high end. And you'll be like, oh yeah, I have a 5 and a 6. And you can start seeing like, well, if you want to hold it for yourself, that's great. But it's also very valuable where you can sell it to another person because what you have now is super valuable. Let's see here. What'd you say there, Ron? All right, Ron says I bought it 9% in 2022. Wow. That is phenomenal. That is, congratulations, my friend. Congratulations. That is great. And it's real. I mean, that's how the cycles go. That's how the dance goes. So you don't just give up on bonds because like, oh, they're going to be at 0%. If you've already been building your ladder up, even right now, we recognize that the rates are right now, it's probably going to be going lower than it's going to go higher because we've already talked about what caused us to go higher or lower. And as our economy kind of stays slow as it is, whether you want to talk about just the uncertainty, there's lots of businesses that are just like, dude, I don't know what to do. Or you want to talk about just the trading and the issues with the supply shocks. You want to talk about some of the export import wars where people are blocking our supplies from different places, and then we have our own tariffs that people now aren't shipping to us. There's a lot of uncertainty, and that always slows down the economy because I don't know if I should hire more people. I don't know if I should fire people. Like, I'm not 100% sure what I should do. And so most people try to wait for the certainty. And as we continue in this uncertain environment, it just kind of drags along because a lot of businesses aren't sure. And the only thing they are sure about, at least for the short term, is that they want to invest in AI because there's a lot of money to be made right now in AI. And I know I saw that Amazon was laying off like 40,000 people from their AI investments. And I think they've already laid off the first 15,000. And they were talking about going so hard on AI that they think that they might lay off 200,000 people. Like, it was like a crazy number. And so that's the only thing that we sort of know right now is a lot of businesses are trying to figure this out. Even the H-1B, I was reading about it was actually a hospital in a rural city, and apparently there wasn't a lot of people who wanted to work at the hospital out in kind of like the rural, the boondocks, kind of the country out of the cities. And so they would get foreigners with their HB1 visas. And all I do, we can't pay $100,000 for this doctor. So there is a doctor shortages in some of these rural hospitals. And I don't expect you to read all this stuff. I just find it super interesting. But everything is connected. And it is something that you recognize that I have to make an economic decision, right? We're not talking about the culture, we're talking about economic decisions. Like, even if you were to, and I was just reading about, there was like a new factory opening, you'll always notice that the way that they position it is they're saying this country is investing $100 billion in like the United States, right? And you're like, oh, it's going to be jobs. But I would ask it to you this way. If you knew that there was a factory down the street that was very automated, robots, AIs, and it can push out Reese's. I love the Reese's chocolates, one of my favorites, so don't judge me. That they make like 2,000 Reese cups every single minute because of their automation. And there's probably like 20 people, right, in the factory. There's not a lot of people because it's all automation. And there's a handful of people at a couple of spots to make sure that the wheels and the cogs are still moving, but it's almost all automation. Or would you build your factory with individuals that would make it like back in the day when Reese's first started, and they can make 1,000 in a day? So you could have it automated with AI and do 1,000 a minute, or you have it with people and they can make 1,000 a day. And I think we both recognize you're not going to purposely build a factory that is obsolete when you recognize the innovations that are going on. And so when I read those numbers, in my mind, I rarely compute it to mean, oh, those are like jobs being created. It's not going to be that many, right? And that's just my humble opinion. I know it throws people off. All right. So after your bonds, the next one that you normally look at, because we're like, hey, if the bonds are going down, what should I do? The idea is if you were to lock in a annuity. And so annuity is a personal pension. So you can have wow, I spelled that really badly. So you can have your pension not just from your employer, because you can, but a personal pension would be the equivalent of an annuity. And so you give them the money, you have what's called a deferred annuity. And all that means is that I set it up, I place the money in there on whatever frequency I want, and then it's called annuitizing. And that's when I lock it. I can't put any more money in. You normally have a period that you have to wait. So normally it's 2 years. And then from that day forward, you receive your monthly check, whatever amount you get, and however it's calculated. And your pension is sort of the same way. It's just done, instead of you directly with the insurance company, it's done through your work, who then contracts with that same insurance company, because it does need to have underwriters and actuaries that can guess how long everybody's going to live to know how much you have to invest to actually keep the pension working. And so they're the exact same instrument, an annuity or a pension. It's just whether or not the annuity is paid for by the business or whether you have your personal one with the insurance company directly. And the idea is basically that. It's like, I have this certain amount, and let's see what the annuity rates are currently. And so let's see here. So there is annuity.org, which seems like a safe place to look at them. And they're like, hey, all right, so the annuity rates are around that 5.5, so about 5 to 6%, right? It's also going to be tied to those Fed fund rates, so they would be impacting them as well. And the way you would think of it is I'm going to lock in a certain interest rate and then I put a certain amount in. Again, we recognize that there is a trade-off, that you're probably not going to get the growth that you would get if you invested outside in the market yourself. But if you're talking about the floor and the safety net, where the goal is just to make sure I don't go broke, that is where an annuity as a risk protection would fit in. And the same with your pension, right? The idea is now some of the older pensions, depending on when you started working, they're less common now, but there used to be the pensions that they would actually increase it with inflation for you. And that's not as common today. But if you have a pension that increases with inflation, then that actually gives you the opportunity to have more than just a I don't go broke fund, but you actually could have something that could fund your whole retirement, really. And so you and I can recognize that there are ways that the underwriting, and they're called riders, where you can add them. So if you were to get an annuity, you could add things, different riders to them. And one of them could be an inflation rider, where like, hey, my annuity payment goes up with inflation. Now, of course, there's a cost for every single rider that you add. You would think of it, if you ever built a house from the ground up, where you go in there like, hey, this is the kitchen that we start with. And you're like, okay, cool. And they're like, well, you can upgrade to, instead of, 8-inch cabinets, like 10-inch cabinet or something like that. Instead of 8-foot ceilings, you get 10-foot ceilings, where you're like, we can add all these other things. It's going to cost you. And then you're looking and like, okay, well, what does it look like? And like, all right, well, all these add-ons this will be the new price of the house. It's sort of like that you have the bare minimum annuity, and then you have the bells and whistles that you can add. And then from there, it changes what the amount that would go towards the fees and the amount that would go towards your actual annuitized monthly payment. And then everybody can decide how they feel from a risk perspective, what makes the most sense on that. But it is always an option that's available for you. And so you can have a fixed annuity, you have a variable annuity, and then there's a whole bunch of them. I am talking about a fixed annuity, because the variable annuity is the cost of a variable annuity, like the wrapper of those investments. It's difficult. Like, it's difficult for that math to math for you. And so when you're really talking about annuity, we're talking about the way annuities have been for literally thousands of years, which is I give you some money and you promise to give me a check the rest of my life. And even if you look in the most ancient of times, if you worked in the military, even in the Romans, where they had annuities for the soldiers, it was like, you work in the military for a set number of years, and then we'll give you a check the rest of your life, right? Like, that is what an annuity is. I know that we've really added a lot of stuff to them. I would say the only ones that I would consider outside of just your traditional annuity is I'm really, I think the fixed indexed annuity, where it's just kind of tied to something, could be tied to like the SP 500. It has floors and ceilings. There are a couple of ways where you can make it work, but the idea is I have this baseline. So I have my annuity, and we'll go back. And so the idea is I have my annuity. That's going to be a set check for the rest of my life. I set it up. I have my 6%, and then it's going to go towards my baseline, right? So this is my floor. I have a certain amount. It's my don't go broke, sleep safe at night, very comfortable. So I have my bonds, I have my annuities, and I'm able to start really building this safe bucket. And depending on how much we have versus how much we need, there are some people that have up to 50% of their retirement income in the safe bucket. And then there are some that use the moderate and the aggressive. It just really depends on how each of us are and how we feel about things. Remember, the goal is to cover like a rent or foods or groceries, things like that. The third one that you would consider, let me zoom out a little bit. So the third one that would make sense for our safe buckets, right? We had like number one, bonds, and then we considered the annuity, the fixed ones, right? So if we start talking about variables and different ones, those wouldn't be considered safe. We would move them to our moderate, to our aggressive. But we're talking about just the safe ones. Your annuity and your pension will give you your baseline. And then the third one would be, of course, like CDs. And you know that CDs, it depends on how long you allow the bank to hold your money. And so when we talk about a CD, the idea of a CD, a certificate of deposit, is banks loan out money, right? We have a fractional banking system, very fancy way of saying that the banks give out more money than they actually have every single day. The bank creates money. And because the banks create money, if all of us ever went to the bank and said, hey, I'd like to withdraw my money, the bank would close, right? And so that's why banks are like, well, how about we incentivize you to not ask for your money for at least 1 year, 2 years, 5 years, 10 years, and you're able to get a CD at any of these type of intervals. Naturally, as you would imagine, the longer that you're willing to allow the bank to hold your money so they can lend it out, the more that they're willing to pay you. And then they do have different penalties that they give you as well. And so when you're looking at, and normally CDs are all going to be sort of around that same area. So the CDs, my money market, and then we're also going to be talking about like our bonds. They're all going to be roughly around that same rate. And so we'll just go quickly. All right, so here's bankrate.com. They give us a couple quick ones, and they say the best CD rates for October 2025, and they're saying up to four and a quarter. And that's not super surprising. We've already kind of looked at a bunch of different ones. We see that that's kind of where the rates are generally set at because of the Fed fund rate that they set it at, where it was before today. It was at 4 to 4.5, and now it's at 3.75 to 4 because they lowered it. And so we recognize that, all right, so it's going to be around 4%. That's what it is. Now this one's a minimum $100, term at least 6 months. If you leave them alone for 6 months, they'll give it to you. You'll recognize normally that they're all going to be roughly around the same because they're all sort of borrowing the money the same way, and then you just decide what the rate is and how much you're willing to deposit. And naturally, you want to make sure it's a bank that's going to be around, because that is the risk that we're all dealing with, and the risk is very straightforward. If I buy an annuity from an insurance company, I have to believe that insurance company is going to be around in 30 years because I want that paycheck my whole retirement. If I have a CDE and that CDE is like whatever, 1 year, 2 year, 3 years, well, I'm not trusting you that much, but I do still need to trust you to be around for at least those 3 years to pay me back my interest. I need to give my money. That you and I don't just let anyone borrow our money. We recognize that, yeah, I need to know that they're going to pay me back. I need to have a fingerprint. I need to have you sign some stuff in front of a notary. I need to take a picture and have one of your teeth so I can identify you, right? Like, obviously, I'm kidding. But when we let people borrow money, we do take into consideration the likelihood of them paying us back. That we're not giving out gifts. If you give out a gift, you don't care. But if you're letting someone borrow your money, you always consider, all right, what's the likelihood this person pay me back? If they paid me back last time, are they good? Did they take care of people? Because if they don't, why are you giving them your money? So we do keep all of that into consideration when we're talking about CDs. But as you see, the CDs, they're going to be about 6 months. We'll say about a 6 month minimum, and then we'll say it's around 4%. And so what you're recognizing is I can actually, if I have my number, right? So I hit my number, I don't need much growth. As long as inflation stays around that 2 to 3% where it typically is around, I can have a relatively safe bucket portfolio in our current environment. Right? We just talked about the idea of the rate does change as the economy changes. And if it does tank, then the rate's going to be at 0% like it was right after the Great Recession. And then that makes it a little bit more difficult. But if you've already been purchasing these when the economy is higher, right? Ronald had talked about getting a 9%. That's phenomenal. That if you were able to lock in when the rates were higher and you purchase a decent amount, they only become more valuable as the rest of the rates go down. Because if the rates keep going down, then even when you're balking at 5% last year, you're like, man, there used to be 7%, there used to be 9%, it's 5%. Well, now people are going to be at like 3%. And you're going to have the best options available, right? It does keep changing. And so we know that the economy goes in the cycle. We recognize that it's going to continue to drop and go up. But as far as the idea of me setting this up, normally the CDs are going to be about 6 to 36 months. And then we often use that as a refill of our bucket because we can live off of that. And ideally, we're able to beat inflation and we feel really good about that. And so these are going to be normally our calm, safe players. And so I've seen people where they've set it up, and there's a couple ways to set it up. And I've seen it where we'll have our, actually, we'll come back up to our bucket. We'll come back up to our bucket. And I'll write them in the bucket. We'll zoom in so that it fits a little bit easier inside of the bucket. So I've seen it where they will have their safe and short term, that they will have their CDs here, right? We're just giving it to the bank. 636 months is relatively okay. And then they would use their bonds. They would be a little bit more aggressive on bonds, not like junk bonds. We're not getting crazy, which as I was telling you about earlier, how confusing it is the way that they grade the bonds, where it's like a double A is not investment grade because it's like a triple A and a B, and then it's like quadruple A. It's like weird gradings. Also, junk bonds, if you were to look up like where are the junk bonds, it wouldn't say that. They would be called like high yield bonds, and you're like, what makes a high yield? Because it's a business with really bad credit. And as you would imagine, who's going to pay the highest interest rates? Yep, just like the consumer side. People with the worst credit pay the highest interest rates. Businesses with the worst credit pay the highest interest rates. And so we're talking about somewhere in the moderate, not getting too crazy, but somewhere in the moderate. And then you could have your, not as much as your, so it'd be less that we're talking about your growth as much as we're kind of talking about your long term. And then you have like your annuity in there. If you were someone that was like, I just want to have like I'm really risk averse, right? Like Dre is it's gonna stress me out. How can I set it up? Right? You can set it up like that. And then it's up to you as far as the other options that you would like to add. And so you could add dividends. And if you are risk averse, I normally will tell you to look at things like dividend kings and dividend aristocrats. Oh, I didn't make it. Because a dividend king means that that company has paid a dividend for at least 50 years, which is crazy. A dividend aristocrat means that the company has paid dividends for at least 25 years, which is also crazy. But as far as the risk that you're taking on, you and I would imagine that you're probably not taking on a significant amount of risk investing in dividends in companies that are paying dividends for 50 years. Like if you just said dividend kings and looked up the list, those companies are going to be staples that have been around for literally like 100 years. Talk about like GE and AT&T, companies been around for a really long time, and it'd be very unlikely that you would be that you would be misled by them just because of how long they've been around. And the reason we normally will limit that if you're on the safer side where you don't like a lot of risk is because if you just go by the dividend payout ratio, which is what percentage of your earnings do you give out in a dividend? And normally we look to be around 50 to 75%. And what that means is if you have earnings of $1 and then you have a dividend of 50 cents, that means you have a 50% payout ratio. We would consider that normally okay. You got half the money to reinvest in the company and grow it. You give us half of the dividend. Normally it's okay. But if you find a company that is giving a 100% payout ratio, so the earnings were $1 and the dividend was $1, there's companies out there that have a payout ratio of 150%, where the company made $1 and they gave you $1.50. And you can recognize how long term that's probably not, that math's not mathing, right? That math is not mathing long term. And so normally you'll look at that. I see in some people that what they'll do is they like hobbies, and so they'll have like a side business, and that definitely can work depending on what you're doing and just how you feel. A lot of people like to just interact with people on a regular basis. Some people like to have things to do on the weekend, but if you use your side business almost as a way to help fund some of this, you can. And so you can offset, or you can at least grow these portfolios as well. And then there are some who will dabble in real estate. Now, I would personally put that one in the aggressive bucket because it's possible that no one's living in there, and it's possible for the value of your homes to go down. Naturally, historically, over the long term, they typically go up, but there is a lot more risk. But there are people who don't consider it risky because they do so much in real estate. They know it inside and out. Family's always done it, whatever. I did it as a business. When I was working, when I was younger, like there are so many reasons that someone would be comfortable. And so I've seen people will use these as their additional income streams. So you have like your CDs, your bonds, your annuities, and then you have your dividend income that's coming in, or you have a rental property. So you have a rental income that's coming in, or you'll have kind of like a small side business where you have like $1,000, $3,000 a month they generate in your business. And then you could have your entire income stream that's set up outside of that. And you put yourself in a really good spot. And what you're really talking about is like, hey, how do I build a paycheck that's separating my time from my money? All right, this is how you would end up doing it. Someone has to work. Economically, we have two things. We have our money and we have our time. Those are what we trade in this world. And we try to do the best trades that we can. And so if you have your money working, then you can purchase more of your time. And as you purchase more of your time, then you get to choose how you want to spend it. But if you don't put your money to work and you give your money, you spend your money, and then other people put your money to work, then that money becomes their tool for their time. And it doesn't become one for you. So over our lifespan, they say that we'll all have $2 to $5 million come in and out of our hands throughout our entire life. And the question is how much of that we're able to keep and put to work for you in your own personal retirement. And so I have seen it where what we could do is, let me give you a quick example and we'll see. So I have seen it where someone will say, all right, so I will have in my CD. So for this one, we'll do like a quick, like a 500,000 example. and how it could generate someone like $30,000 a year. And then you add that with your Social Security, boom, they have around the national average is about 50,000 what people spend in retirement. So if you could have, so you could have like $100,000 here in your safe, and then you would have that in your CDs generating about that 4% for you. Then you have your bond ETFs where you would have your moderate, and we're going to put 250K here. And then we're going to be around that same 4% we're going to have there. And then we would have our fixed annuity. And so that would be about 150K in a fixed annuity, right? A fixed annuity, and that would generate about $800 a month for you, roughly around there. And so from there, you can see that we'd be able to have, and that would be roughly about 30,000 a year. Now the question becomes, right, do we have other streams to be able to add on to this? Because we still have the aggressive and the growth. But if you were just like, I want to play it as safe as possible, I don't really want my money in the market, what does that look like? This is what that would look like. If you were like, hey, I want to play as safe as possible, this is what it would look like. And so your fixed annuity could be from your employer, right? It could be a pension, or it could be one that you purchase yourself. And then we're just going through the numbers of that, and you can see how it would end up working, where you're able to kind of spread it out. You have your money that's set aside to pay your normal living expenses. You have what you would consider moderate, which would be your bond market, and then you have your fixed, that's your long-term investment. So that's your floor. You do everything wrong, you still have your $1,800 a month, and then you have the ability to stack onto that from there. All right, and that, my friends, that is it. All right, so you're worried about money, then hopefully this is one that gives you that peace of mind where you don't have to worry about it, my friend. I always appreciate the time that we have together. What did you say there, Ronald? Yes, doing your due diligence is a must, because we're making long-term investments with people. If you watch, the way I think of it is, and the way I choose stocks and everything else, I think of it like I'm a Shark Tank investor, that I am literally being pitched by this company, and I am deciding whether I'm going to say yes to your offer or if I'm going to counter offer you. And that's how I think of it. And so if you think of your money as you investing like Shark Tank, you wouldn't just give the money to someone who has a nice poster behind them. You wouldn't give the money to someone who has a cool mascot or a great commercial or a wonderful smile, or they say all the right things. You would invest in that company based on asking some serious, hard questions like, what are you going to do with my money? When am I going to get it back? And what type of return can I expect on my money? And what history do you have that proves to me that I can believe what you're saying? Right? Like, these are real Shark Tank type of questions that you would ask. And I think that everyone should ask those type of questions when they're choosing companies to invest in, because that's what you're doing. You're investing like a Shark Tank investor. All right, as always, I'm thankful for the time that we have together. I'm Dre, founder of Ascending Wisdom, where I help people to use more wisdom and less worry. Until next time, stay safe and enjoy